You pay for a promise. Every month, every year, money leaves your account and goes to an insurance company. The deal seems simple. If something goes wrong, they pay. You've held up your end of the bargain for years, maybe decades. Then one day, something actually happens. A storm destroys your roof. A car crash puts you in the hospital. A fire takes everything you own. You file a claim, expecting the system to work the way it was sold to you. And that's when you discover the truth. The promise you've been paying for all these years has fine print you never saw, escape hatches built by teams of lawyers, and a process designed not to help you, but to protect the company from having to pay. Americans hand over more than $1.5 trillion to insurance companies every single year. That's not a typo. Trillion. With a T. Health insurance, auto insurance, homeowners, renters, life, disability. It's one of the largest wealth transfers in the modern economy, and it flows in one direction. From you to them. But here's what almost nobody talks about. A massive portion of that money never comes back to policyholders. Denied claims, delayed payments, lowball settlements. Policies rescinded at the worst possible moment. And almost all of it is perfectly legal. The insurance industry has spent decades building a system designed to collect your premiums and avoid paying your claims. This isn't a conspiracy theory. It's a documented business model. And if you don't understand how it works, you're walking into a trap you already paid for. Let's start with something most policyholders never think about. When you write that check or watch that automatic payment leave your bank account, you probably assume that money is sitting somewhere, waiting to pay claims. It's not. Insurance companies take your premiums and invest them. They buy stocks, bonds, real estate, entire companies. The premiums you pay become their capital. In the industry, this is called the float. Warren Buffett built a significant portion of his fortune on this exact principle. Berkshire Hathaway owns multiple insurance companies, not because Buffett loves helping people after car accidents, but because those companies give him billions of dollars in float to invest. He's made this explicit in shareholder letters. Insurance premiums are essentially interest-free loans from policyholders, money he can invest until claims come due. And here's the twist most people miss. Even if an insurance company pays out more in claims than it collects in premiums, a situation called an underwriting loss, it can still be wildly profitable because the investment returns on your money more than cover the gap. The largest insurers in America sit on combined invested assets exceeding $8 trillion. That's not their money. That's built from your premiums, accumulated over decades. They're making money on money you gave them, and they're in no hurry to give it back when you file a claim. Every day they delay a payment, that money stays in their investment portfolio, generating returns for them. But the real machine kicks in when you actually need to use your policy. And this is where the game gets ugly. Insurance policies are not written for clarity. They are written for protection of the insurer, not the insured. Teams of lawyers spend years crafting language that creates maximum ambiguity and maximum escape hatches. You've seen the result. Policies that run 40, 60, 80 pages. Dense paragraphs of legal jargon that require a law degree to parse. Exclusions buried so deep that you'd need hours of careful reading to find them, let alone understand what they actually mean in practice. And this is intentional. The complexity is not a bug, it's a feature. Consider something called an anti-concurrent causation clause. It sounds technical because it's meant to confuse you. Here's what it actually means in plain English. Let's say a hurricane hits your home. The wind tears off your roof. Then the floodwaters rush in and destroy everything inside. Your policy covers wind damage. But it excludes flood damage because you didn't buy separate flood insurance. A reasonable person would think the insurance company should pay for the wind damage at minimum. The roof was destroyed by wind. That's covered. But the anti-concurrent causation clause says, if any excluded cause contributed to the loss, even partly, even secondarily, even afterward, the entire claim can be denied. Everything, not just the flood damage, all of it, including the roof that was clearly destroyed by covered wind. This clause has been used to deny claims after hurricanes, wildfires, earthquakes, and other disasters. Policyholders who paid premiums for decades discover that a technicality buried on page 47 means they get nothing. And the courts have upheld these clauses repeatedly. Because the policyholder signed the contract. Because the language was technically there, because nobody forced them to buy that particular policy. Now we get to the playbook. And yes, it's an actual playbook, documented in lawsuits, revealed in court proceedings, confirmed by industry whistleblowers. In the early 2000s, consulting giant McKinsey Company was hired by Allstate, one of the largest property and casualty insurers in America. Their job was to increase profitability. The result was a comprehensive strategy that became infamous in the industry. Internally, it went by various code names. Externally, it became known by a simpler description: delay, deny, defend. The concept is brutally simple, and it works. First, delay. When a claim comes in, don't process it quickly. Let it sit. Request additional documentation. Send it back for more review. Ask for the same information multiple times. Every delay increases the chance that the policyholder will give up, settle for less, run out of money waiting, or miss critical deadlines under statute of limitations rules. Second, deny. When possible, deny the claim outright. Find a technicality, a form filled out incorrectly, a box left unchecked, a minor discrepancy in dates between different documents, a clause in the policy that could maybe, possibly, under aggressive interpretation, apply to the situation. The goal is not to win every denial. The goal is to deny enough claims that the total payout drops dramatically. If you deny 1,000 claims and only half get appealed, you've already saved money on the 500 that were never pursued. Third, defend. When policyholders push back or hire lawyers, fight them. Drag out litigation for years. Make the process so expensive and time-consuming that most people give up before reaching trial. Because here's what the insurers know. Most policyholders don't appeal. The statistics are staggering. Fewer than 1% of denied claims are formally appealed. People assume the insurance company knows better, or they can't afford a lawyer, or they're too exhausted from whatever disaster prompted the claim in the first place, or they simply don't know they can fight back. The delay, deny, defend strategy weaponizes this reality. Allstate wasn't primarily trying to win in court. They were trying to never get to court. But even when claims aren't denied, the payout often doesn't match the actual loss. And this is where the lowball machine runs at full speed. When a claims adjuster calculates what you're owed, they're not starting with what it actually costs to fix your damage. They're starting with what they can get you to accept. One of the most common tactics is aggressive depreciation. Let's say your 10-year-old roof is destroyed in a storm. The insurance company sends out an adjuster who determines it'll cost $15,000 to replace that roof. But they don't offer you $15,000. They calculate depreciation, how much value the roof has theoretically lost over 10 years of aging and wear, and offer you $7,000, maybe less. The gap, they say, is on you. Never mind that you can't buy a 10-year-old roof anywhere. Never mind that the only option available to you is a new roof, which costs $15,000. They call their reduced payment actual cash value, and they present it as standard practice, as if there's no other way to calculate what you're owed. The policy might technically offer replacement cost coverage, but often, the insurer only pays the actual cash value up front, forcing you to front the money for full repairs yourself, and then fight to get the rest reimbursed after the work is done. If you don't have that cash on hand, you're stuck. And the insurance company knows from their data that millions of policyholders don't have the resources to bridge the gap. So they accept the lowball offer because they have no choice. Settlement tactics prey on desperation by design. After a disaster, after a fire, a flood, a serious car accident, a major injury, people need money fast. They're facing mounting medical bills. They're displaced from their homes. They're out of work and watching their savings drain away. This is exactly when the adjuster arrives with a quick settlement offer. It's always lower than what the claim is actually worth under fair valuation. But it's presented as a favor, a lifeline, a way to end the stress and move forward. Sign here, and you'll get a check in 2 weeks. The catch that isn't always clearly explained is that signing means waiving your right to pursue more compensation later. You accept, you're done. Forever. And the insurance company just paid 50 cents on the dollar for a legitimate claim, sometimes less. There's another tactic that most people never see coming until it hits them. It's called post-claim underwriting, and it's exactly as predatory as it sounds. Here's how it works. You apply for insurance, you fill out forms, answer health questions, provide information, and start paying your premiums. The insurance company accepts your money. For years, maybe decades, everything seems fine. Your premiums get paid, your policy stays active. Then you get seriously sick, or you're in a major accident, or you file a substantial claim. Suddenly, the insurance company launches an intensive investigation, not into your claim, but into you. They comb through your entire history, medical records from 20 years ago, statements you made on the original application that you've long forgotten. They're looking for any discrepancy, any omission, any technicality that could let them cancel your policy. Not just deny the claim, cancel the entire policy retroactively. And often, they don't return your premiums either. You paid for years, they kept the money, and now they say you were never actually covered. This is called rescission. Health insurers became particularly notorious for this practice before the Affordable Care Act put some limits on it. People who paid premiums faithfully for years, who had every reason to believe they were covered, found their policies voided the moment they needed expensive treatment. The insurer would find a minor error on the original application, maybe a prescription the policyholder forgot to list, or a doctor's visit from 15 years ago that slipped their mind, and use it to argue the policy was never valid in the first place. Regulators eventually cracked down on the worst abuses, but the practice hasn't disappeared entirely. It's just gotten more sophisticated and moved to other areas. And in property and casualty insurance, post-claim investigation remains standard operating procedure. File a big claim and expect your insurer to go looking for reasons not to pay. Now, you might assume that at least the claims process involves genuine human judgment, someone looking at your specific situation, weighing the evidence, making a fair and reasoned decision based on the facts. Increasingly, that's not the case. Insurance companies now rely heavily on algorithms and proprietary software to process claims. One of the most notorious is a program called Colossus, used by many major auto insurers to evaluate bodily injury claims. The software takes in data about your injury, your treatment, your medical costs, the duration of your recovery, and various other factors. Then it spits out a settlement number. And here's the problem nobody talks about when they hand you that number. Colossus is not designed to determine what your claim is actually worth. It's designed to generate numbers that, on average, result in lower payouts for the insurance company. The adjusters who sit across from you, who seem to have authority, often have no power to override the software's determination. They can advocate, they can note their concerns, but the algorithm makes the final call on what gets offered. And the algorithm was trained on data from the insurer's own historical claims, data that reflects decades of systematic underpaying. Multiple lawsuits have alleged that insurers deliberately calibrate these systems to lowball claimants across the board. Settlements that would have been negotiated fairly 20 years ago, with human discretion and reasonable assessment, now get run through a black box that nobody outside the company fully understands. And when you push back, you're not arguing with a person who can see your suffering. You're arguing with software that doesn't care and can't be moved by circumstances. The human adjusters often feel the pressure too. Whistleblowers from major insurers have described internal quota systems, explicit targets for how many claims to deny, how many to close quickly with minimal payout, how much to cut from settlements every month. Adjusters who approve too many claims or pay too generously find themselves in uncomfortable performance reviews. They get passed over for promotions. They experience pressure to fall in line. Some are eventually pushed out entirely, replaced with adjusters who understand what's expected. The system is not designed to evaluate claims fairly and compassionately. It's designed to minimize payouts while maintaining barely enough legitimacy to avoid regulatory action. And when it comes to actually changing the system, the odds are stacked heavily in one direction. The insurance industry is one of the most powerful lobbying forces in America. They spend well over $150 million every year on federal lobbying alone. At the state level, where insurance is primarily regulated, the spending is even more intense and the influence even more direct. And it works. Laws are consistently written to protect insurers, not policyholders. In most states, there's no meaningful penalty for an insurance company that wrongly denies a claim. Even if you fight back and eventually win, the company usually only has to pay what they owed in the first place. No penalty for making you fight for it. No compensation for the years of stress and legal fees. Some states have what are called bad faith laws that allow policyholders to sue for additional damages when insurers act in demonstrable bad faith. But those laws are the exception, not the rule. And even where they exist, courts often interpret them narrowly in favor of insurers. The revolving door makes things worse. State insurance commissioners, the regulators who are supposed to protect consumers and police the industry, often come from the insurance industry and return to lucrative industry positions after their government service. It's a textbook captured regulatory system, where the watchdogs and the watched are essentially on the same team. But here's where the story shifts, because not everyone accepts the denial letter. Not everyone takes the lowball offer. And when policyholders actually fight back, something remarkable happens. Bad faith lawsuits have exposed internal practices at major insurers that shock juries and judges alike. Documents showing explicit written instructions to deny claims whenever possible. Emails from executives celebrating reduced payouts and praising adjusters who close claims cheaply. Training materials. Teaching new hires exactly how to find technicalities and exploit policyholder confusion. These cases don't happen often because most people never get that far. Most give up long before trial, but when cases do make it to court, the verdicts can be massive. Juries have awarded policyholders millions of dollars in punitive damages, not just for the original claim, but as punishment for the systematic way the insurer behaved. Class action suits have forced insurers to change practices, at least temporarily until attention fades. Settlements have revealed documented patterns of systematic underpayment affecting hundreds of thousands or even millions of policyholders. And what the winners usually know, what separates them from everyone else who gave up, is straightforward. They don't accept the first offer. They document everything obsessively. They get independent estimates from contractors and professionals not affiliated with the insurer. They hire public adjusters or attorneys who specialize specifically in fighting insurance companies. And they refuse to give up when the insurer says no, the first, second, or third time. Here's the hard truth nobody in the industry wants you to understand. The insurance industry isn't broken. It's working exactly as designed. It's designed to collect maximum premiums and pay minimum claims. It's designed to exhaust you, to confuse you with complexity, to make the process so painful and time-consuming that you give up and walk away. And for most people, it works exactly as intended. Most people pay for years and never file a claim. Most who do file accept whatever they're offered without question. Most who are denied never appeal. The insurers know this with mathematical precision. Their actuaries have calculated exactly how much resistance the average policyholder can sustain before accepting a lowball offer or walking away in frustration. The system exploits that calculation every single day, at massive scale across millions of claims. So, what does this mean for you? First, understand that your insurance company is not your friend. They're not on your side. They're not looking out for you. The commercials with friendly actors and catchy jingles are pure marketing designed to create false comfort. The reality is a multi-trillion-dollar industry with armies of lawyers and actuaries laser-focused on paying out as little as legally possible. Second, read your actual policy, not the summary, not the brochure, the actual policy document. Find the exclusions, understand the coverage limits. Know what triggers the anti-concurrent causation clause. Know what counts as actual cash value versus replacement cost. This is boring and tedious. It's also the difference between getting paid and getting denied. Third, document everything from day one. When you file a claim, create a comprehensive paper trail. Get everything in writing. Keep detailed records of every conversation, every email, every promise made by every adjuster. Insurance companies are remarkably good at losing track of things you told them verbally. Fourth, never accept the first offer without questioning it. Get independent estimates from professionals who don't work for the insurer. Hire a public adjuster if the claim is significant. Consult an attorney who specializes specifically in insurance disputes. The first offer is almost always lower than what you're actually entitled to under your policy. Fifth, appeal every denial, even when it feels hopeless, even when you're exhausted, even when they make you feel like you're wrong. The statistics are absolutely clear. Policyholders who appeal win far more often than those who don't. Insurance companies are counting on you to give up. Proving them wrong is often enough to completely change the outcome. The system exists because we let it exist. Because most people never question the denial letter, never push back on the settlement offer, never read the policy they've been paying for. Insurance companies have spent decades building walls between you and the money you're owed, but those walls are not as strong as they look. They're built on the assumption that you won't fight, that you won't question, that you'll be too tired, too confused, too financially desperate to do anything but accept what you're given. Every time someone pushes back, those walls crack a little. Every bad faith verdict, every class action settlement, every denied claim that finally gets paid after an appeal, it proves the system can be beaten. Not easily, not quickly, but it can be beaten. The insurance industry wants you to believe that claims processing is neutral and fair, that denials are just objective decisions following policy language, that lowball offers reflect fair market assessments. None of that is true. Behind every denial letter is a business decision. Behind every delay is a calculated strategy. Behind every settlement offer is a determination of how little you'll accept. And behind all of it is over $1 trillion of your money invested for their profit, generating returns for shareholders, while you wait for a check that may never come. Now you know how the machine works. The question is what you're going to do about it.